So S&P 500 for the record, I think for the past 20 years, the return is about 9% per annum. So ask yourself how much do you think you can outperform, or do you really think you can outperform 9% for 20 years track record? Because yes, maybe 1 or 2 years you can 30-50%, but are you that consistent to beat 9%? As a start, even me myself, I don't think I will be able to beat 9% as a start lah. Because like EPF probably 5.56%. Your fixed deposits now is like 3+%. Yeah, is there anything that comes close to 9%? Probably not.
Welcome to the iSearch podcast. Today we have Ziet, a senior analyst in a local public listed company, on the show to share with us on why you should invest in the US market and also how to get started as a Malaysian. So welcome to the show, Ziet.
Thank you very much, Benjamin. Pleasure to be here. Really excited to share with you.
All right, great. So could you share with us what is the current state of the US market currently?
Okay, I think a few words doesn't do it justice. I think the US market now is in a pretty unique position. The US, they have a very high inflation right now. In Malaysia, we have 4%. Right now, the US is at a very high inflation of 7.7%, and their fixed 30 years mortgage rate, which is the mortgage loan, is over 7% right now. Malaysia right now, I was talking to a few bankers recently. Now it's 3.8% only. So you can imagine the living cost over in the US is pretty it's pretty high right now lah. So and why did I say it's a pretty unique position, right? Well, the US Federal Reserve, or their central banks, basically their Bank Negara, they are doing a series of interest rate hikes, and in this year alone they have hiked I think 4%, which is 400 bits, which is a lot. No country has ever done that in precedent lah. So, and they are gonna approach 5% in a few months' time, probably Q2 in 2023. So, because when you have a series of rate hikes, inflation will start to slow down, and it has shown that it has peaked in June this year. So we have shot to a very high US CPI of around 9.1%, and now they are slowing down to 7.7%. So they see that inflation has peaked, so they are trying to slow down their interest rate hike, which is what they call it, a pivot from increasing so much to being slower. So once they slow down the interest rate hikes, that means from a fast rate to a slower rate, then becomes zero, then eventually they will start to cut interest rates again, like during the pandemic. So that is where the stock market will start to rally again, because free money is coming in again when interest rate is starting to being cut. So that is on the more optimistic side, I would say, the position we're in right now. But obviously, that comes with a potential issue. I was actually just explaining to my friend yesterday, the investors in the US right now, or just investors investing in the US market right now, are like hikers climbing Mount Everest. We can already see the peak. We can already see we are reaching the peak. Well, you are 30 minutes away from the peak, but all it takes is one big hurricane, 5 minutes before the peak, and you are blown away, and you're buried down 6 feet deep in the ice already. So there are potential issues that may happen. Well, we see that the disposable income for the average Americans have plummeted drastically in 2022 from, I think, over 1%, now dropped to 0.3%. Very, very low already. That means people have lesser and lesser cash to spend on things left and right, because they are paying such a high mortgage rate. So when people have less to spend, what does it mean? There will be lesser revenue for businesses. Lesser revenue, lesser top line means lesser profits. And that will translate to a very disastrous quarter for the Q1 or Q2 next year. So the potential of a earnings recession is looming for sure. And then we see that there's also geopolitical fragmentation. The Russia-Ukraine war, the US-China has a lot of issue as well. Chip bans, China's COVID lockdown, not lifting as much. That doesn't help with the inflation and supply chain as well. And then we have energy crisis in the Europe, obviously because of the Russia-Ukraine war. So that is on the more pessimistic perspective of what's happening in the US market lah. So there are good, there are bad, but I would say opportunities could be arising soon, because we see that crypto market meltdown, crash this year, Bitcoin, Ethereum, whatever you name it. Crypto exchanges bursting one by one, FTX, BlockFi, Voyager, who are so many, I can't even remember. S&P 500, which is the largest index in the US market, like the KLCI in Malaysia, it's down near to 20%. And at some point, it was over 20% this year to date. And we see business capital investments, mergers and acquisitions down 30, 40, 50%. Less venture funds investing as well. So that's where the market turns pessimistic, and obviously wise investors should really capitalize on such opportunities. Because when there's, Warren Buffett said this, I think Charlie Munger or Warren Buffett said this, the best time to invest is when there's blood in the street. So this is where investors, not just US residents, right? Even Malaysians, right? We should really start looking into the US market for opportunities, because when the money has been sucked up from the system by increasing the rate hikes, increasing the interest rates, that's where you see high premium companies have been, it's like the tide have receded. So now you see people swimming naked. Companies probably already bursted already. Those high premium companies that have flown to the moon now crashing already. So now you see those resilient companies with really strong business modes. That's where you see opportunities left and right. Yeah.
Okay. So I'm sure that most Malaysians don't really invest in US market. If they invest, maybe most of them will park the money in either Bursa Malaysia or like properties in local scene in Malaysia. So like, what are some things that a beginner should consider before like they decide to invest in US market? Like any tips that you can give?
I think very, very simple, right? Before even considering investing, right? Fundamentally, you need to have a very strong understanding of money, because investing $1 can make you maybe best 20%, 30%, which is 30 cents, right? But being able to do a good budget, have a strong psychology of money, understand what are the basics of money, I think that will bring you further, and know how to utilize your time rather than just investing money into assets, right? You have to invest your time, invest your resources into yourself, because you are your greatest asset. So back to your question, fundamentally, you have to be strong with your money. You need to understand the 3 financial statements very well: cash flow statement, balance sheet, P&L. That's a given, right? And then on a personal level as well, you need to understand your relationship with money, because you need to understand what's your risk appetite, how much can you take, right? Are you an emotional kind of person? Because if you are, then it's good to know, because don't let the ego get into your way, right? Because the last thing you want to be is be ego with money, and then you will lose. So you need to understand what's your risk appetite, and then what's your personal financial situation. Do you have any dependents? Do you have any commitments in the short term, in the medium term? Do you have anything that requires your money? So that you need to really filter and really see your situation. And then what's your investment horizon? How long can you invest? Is it 2 years, then you have to buy a house? Or is it 5 years, then you need to do this? Or is it 10 years? Or you can safely set aside a certain amount of money and then just don't even look at it. If you can do the latter, then obviously that is the best, because there's this advice going around, which I strongly agree with. If you need money in the short term, might as well don't invest it, right? If you need the money in 2 years' time, that to me is considered short term, rather than investing it in growth assets or whatever dividend paying assets, which may also devalue due to its capital appreciation or depreciation as well. Might as well just go for plain and simple cash, or just keep it in money market funds or high yield savings accounts. I think that's like a way for you to mitigate risk. And then when you have your bottoms covered, then that's where you look at the upsides. So to me, that's a more mature and wiser way of approaching money. But obviously, that is my personal take. So those are the things that I think beginners should consider before deciding to invest.
And do you recommend, because investing in US market, we are not really sure which are the stocks or that will do well. Is it better to start with, say, investing in the S&P 500 first? Then from there only you go and pick which stocks that you feel have potential, or how what is your strategy on this?
So for beginners, right, obviously there are a lot of assets and instruments out there, and obviously the most popular one being S&P 500. It is basically the benchmark for investment. So if there's a saying, if you can't beat S&P 500, yeah, probably wasting your time. So S&P 500 for the record, I think for the past 20 years, the return is about 9% per annum. So ask yourself how much do you think you can outperform, or do you really think you can outperform 9% for 20 years track record? Because yes, maybe 1 or 2 years you can 30-50%, but are you that consistent to beat 9%? As a start, even me myself, I don't think I will be able to beat 9% as a start lah. Because like EPF probably 5.56%. Your fixed deposits now is like 3+%. Yeah, is there anything that comes close to 9%? Probably not, right? So you look at
crypto previously. But now that's it.
Year to date, you see what's crypto lah, 95% down, 85% down. Yeah, so I only do assets. I don't look at crypto assets. Yep. So the question is, well, obviously, disclaimer first. Historical performance does not mean future results, right? So does not mean it will repeat, right? So, but the historical is that for the past 8 to 9 decades, 80, 90 years, the return is like what, 8, 9, 10, 11%, cannot run one lah. So the philosophy of investing in S&P is very simple. You believe that the US economy will grow over time. So if you don't believe that, right, then you ask back the question, which country or which economy do you think will outgrow the US market for the next 5, 10, 15, 20 years? China? I don't know. Japan? Probably not even close because they are facing their own issues right now. European Union? Are there any countries in the Europe you think will come close to the US? Probably not. They are facing their energy crisis right now, so they are not even close. China? Probably the second, but it's not even close as well. They are facing a lot of trouble within their country as well, their nation. So I don't see any country potentially disrupting the US, and which is why the US knows that position and they are sort of gamifying the entire world's economy because they are the largest capital market and they hold the world reserve currency. So anything they can, the US central bank can just adjust their interest rates to save their own economy, and the one that has to suffer are the non-US countries, like Malaysia, for example, right? So if you say such a country that has such a strong economic mode and has the potential to control so many ecosystems, like a company like Apple in itself, right? Then what's there to avoid investing in this kind of nation? Unless you have a better argument of the other country can do better, then obviously by all means show me the proof, or we can argue about it. Right, we can do that. So as a start for beginners, S&P is probably the benchmark. So if you think 8 to 9% is what you're looking for as a start, right? You don't need to be religious enough like S&P all the way until you retire, right? You can maybe start for a few months. You look at your risk appetite because you can gain 9% per annum, but that is not a smooth 9%. It could be down 16% this year, down 21% next year, then maybe up 5%, up 2%, up 25%. So smoothen out is 9% lah. That's the sweet word lah. But obviously within that there are bumps left and right. So S&P is probably the way to start. But should you avoid looking at individual stocks? Obviously not lah. Who am I to say that, right? Obviously, if you are a keen learner and you want to take more risk, the thumb rule is there: higher risk, higher reward. By all means, you are free to do that. There are good companies out there. Personally, I like big techs like Apple, Google, Amazon, and also Tesla. That's my 4 only equities that I own. 4 kind of companies that I own in my stocks portfolio. So it could be different for you. You probably no Facebook. Personally, I'm skeptic of the metaverse as well, and the way they, because to me, right, I don't look at Facebook just as on general broad-based perspective, right? People look at Facebook as strong Facebook ecosystem, strong Instagram. Everyone uses Instagram, very beautiful. Everyone uses WhatsApp, but actually in the US, a lot of them don't like to use WhatsApp. They use Telegram already. So do you want to use sentiment to drive an investment thesis? Obviously not, because for me, it's very simple. I look at the ground level. Why is YouTube so successful? They have a very strong monetization tool that can help creators. They have revenue sharing. They encourage more people. They pay more people. They encourage more content. More people come and watch. That cycle loops. But for Facebook and Instagram, it's very weird. They don't do that. And Instagram don't even know what's their core anymore. Their core was a photo sharing app, right? But they moved towards Reels. They want to compete with TikTok. But they are not as good as TikTok. But they are not as good as YouTube. and they don't even do revenue sharing on Instagram. So there are lesser and lesser quality content on Reels. And the content that you see on Instagram is most probably rebatched or repurposed from TikTok or from YouTube one. Very high chance, right? So you are not left and you are not right. Now you lost left and now you lost right. And you go into metaverse, which honestly, like, I mean, what the hell, man? So you're spending like how much? 25% of your annual profits into a venture that has no end in sight. I don't think in 3 years time you'll even see the end, right? For a metaverse lah. So that's why for me I don't invest in Meta lah, plain and simple. And Facebook algorithm wise not strong enough. Facebook platform in itself also losing to Twitter as a news broadcaster or live coverage kind of thing, or maybe just a influencer / celebrity interaction with fans and followers, right? Also lose. So they are not left and they are not right as well. And people are starting to leave Facebook and dub Facebook as like the old man's Twitter or something like that. Old man's newspaper lah.
Yeah, understand. So yeah, I mean, like, I'm thinking from the perspective of a lazy, okay, let's not put lazy, let's say busy investor, right? So if they don't want to keep up with all these kind of news of like what Facebook is doing, what Twitter is doing, what Google is doing, because every day, every week, maybe there's some new changes or the CEO want to implement something new or take out something. So as a busy investor, I think maybe, can I say that it's better for them to just put in the S&P instead of monitoring all the news that's going on in especially like the US companies?
I think that's a fair call, because if you say that you are so busy that you can afford time for investments, which is totally fine. Sometimes I don't even look at my stock portfolio for like days or weeks, right? That's fine, totally fine. Well, S&P is just one of the index. When you want to go passive investing route, obviously you want lower risk, but you're okay to live with lower reward. So when you want to go to that low risk, low reward, you diversify your holdings. It can be holding S&P 500 alone. Some people don't recommend that. So you can also mix with bond ETFs, or you can also mix with the all world indexes, or you can also mix with tech indexes for a little bit of exposure towards tech. So there are a lot of ways to like play with it lah. Like the most common that I see people is combining the S&P 500, which is the US market, the top 500 companies lah, not the entire US company, not the entire US nations lah. Then some will combine with all world indexes, which cover the entire world stock market. Then some will also combine with a little bit, maybe 10-15% exposure towards emerging market or developing market. So that could be a way for you to like allocate as well. And that is usually the so-called foolproof kind of investing. Like every month you just throw money in, don't even look at it. Then hopefully and technically you should get around 6 to 8% per year. Smoothen out. Again, it's smoothen out. It's not like first year 6%, second year 6%, right? That's not gonna happen. Yeah.
Okay, let's say just now you mentioned like the S&P per annum is average when you look at it throughout the past few years, like 9%, right? You mentioned. What about the data for Bursa Malaysia? Let's say, what kind of returns do we see for, let's say, the past, I don't know, 5-10 years?
Bursa, I think looking at the index itself lah, but I know a lot of people will argue and say like, wow, is it not fair lah? KLCI index only the top 30 companies in the Malaysian market, and even in the top 30 companies, probably 10 are financial companies. All the top 10 are, I think 7 or 8 are like banks, like Public Bank, Maybank, CIMB, all these kind of big companies, right? And they say it's not reflective of the Malaysian economy, because on the lower end you also got tech companies like semiconductor companies, right, and glove players, whatever, and also pharmaceuticals as well. So looking at the index alone, KLCI, I believe it dropped around from 1,600 point to a low of I think 1.3, 1.4 today, around 1.4k lah. So that's like over what, 5-10 years, it has been down like what, 3 to 5% per annum for the past 5 to 10 years. That's probably a number at the top of my head. I haven't like follow KLCI for the longest time already, because personally I'm a skeptic of the Malaysian governance structure and the Malaysian economic as well. So yeah, that's my personal take. And I always tell people, right, when it comes to money, right, money don't care about your age, your religion, your beliefs, your skin color or your gender, right? Money is just money, and if you humiliate money, money will humiliate you. So, and if you respect money, money will respect you. So you got to, as an investor, you got to look at money as just a number and just look at it logically. There's no need to tie your patriotism or whatever towards money, right? I still love the country. The country is beautiful. I think Malaysia is probably one of the most beautiful country with the best weather, except for the rainy seasons compared to other countries. But and the people wise is also very nice. Obviously there are like rotten apples out there, but I would say 90% of people I met are really awesome. So Malaysia as a country, beautiful. Malaysian economy wise, absolutely terrible. That's my take.
Yeah, I mean the Malaysian economy is terrible. That's why a lot of people also recommend like to invest in overseas markets lah. But I'm going to throw a hard question, also a speculative question here lah. So with the recent election victory by Anwar, and Anwar being the PM now and also the finance minister currently. So yeah, do you, and many people are very optimistic on Anwar lah, like Anwar can help drive Malaysia to like the next level and will improve the economy. So what is your take on that, on like investing back in Malaysia instead of US?
Well, honestly, I can't give you the best answer because I think a person, to answer that question accurately, one has to be really savvy about the Malaysian economy and politics, and also understand what's the history behind the people behind the cabinet as well. Obviously, I'm not even close to that position to comment on that. But if you ask me, and on a general level, there's no precedent for me to say it will work, right? I mean, it's good to be optimistic, and I love the fact that we have a quote-unquote new Malaysia, because we had back then in 2018, before the Sheraton move happened. So yeah, it's good to be optimistic, and I foresee and I hope we will see greater changes coming to the Malaysian economy. But honestly, at this point, because it's like 1 month in, everything is still hope. There is no concrete evidence. There are no lines or policies being set in place. But obviously, because I think the first parliament also haven't started, right, as of today. I could be wrong, right? So benefit of doubt, we need to give it more months or even years, right, to undo all the problems for the past 6 decades, right? You can't expect within 3 months or within 2 years things are gonna like overturn the stone, and you know what, one US dollar is 2 ringgit already. So that's gonna take a long time to undo lah, because projects takes time to build. Your HSR, your express railing, whatever, it takes time to build. HSR probably take 4 years, 6 years to build. Your mega projects, everything takes time to realize, and you need time to build confidence towards investors. So within 5 years, do I see things flourishing? If it goes as promised, then we would see more greeneries, but will it like flourish to the moon? Probably not, because like I said, projects takes time. And by the time the 5th, 6th year marks comes in, probably another election. I mean, well, not probably. Another election comes in, the cabinet shuffles again, and then it takes time to, if it's not the same government, or if it's not the same unity government, the combination switches again, the structure changes again, the policy have to be refreshed again, another 2 years of lag. And maybe in 10 years time, like even like the day I was listening to the podcast of Genie Boy and also Syed Saddiq, I mean, this is just what I can take away lah. He was saying like he understood that whatever we had cannot be undone that quickly. At the very least, we also need 10 years. So even the professional in politics also say they need 10 years, right? So I personally am skeptic that 5 years can really change anything much. Maybe the direction in 5 years we will see very nice, but whether or not we move towards that direction, I don't think 5 years is enough to see.
Okay, I mean that's a very fair point lah. So let's leave Malaysia market aside first, and we go back to the US market. So for beginners, right, what are some steps to get started if like they wish to pull the trigger and also start to invest in US market for the long term?
Good question. I think as a beginner, obviously there are ways to invest in the US stock market, be it you need a brokerage account, be it through local banks or through international brokerages, right? Through local banks, because banks are incumbents, they tend to play safe. They have a lot of incumbent technology in place. They don't innovate. They don't change according to the they don't innovate, and they don't follow the trend, and they don't innovate themselves. So they are more expensive to trade in the US market or just any other market, like using local banks. Like when I started investing, going through local banks, buying stocks through them, charges me like what, $25 per trade. That's 100 ringgit just to trade once. Whereas today you have brokerages, Interactive Brokers, Momo, TD Ameritrade, First Trade, Webull, wow, you can name it, a Robinhood, eToro, like, you know, Tiger Brokers. I can't finish them, there's too many already. So what they can provide right now, well, even Rakuten Trade, like in Malaysia, what they can provide right now is like what, 50 cents per trade, $1 per trade. That's what, 4 ringgit, 5 ringgit, compared to your 100 ringgit. Today, even today as we speak, at the end of 2022, it's still $25 after all the content I made, after all the hoo-ha in the market, after all the rise of international brokerages. They still don't give a crap about it. They still don't change. They still don't care. Because why? I mean, fair point to them. They don't make money from smaller retail investors like us. They make money from big sharks, big loans. We are probably like what, 0.5% of their top line. So honestly, why would you want to switch up the entire system just to accommodate for the 0.5% or 1%? So yeah. So to get started, first get a brokerage platform. I've done a lot of videos on brokerage platform. In fact, I think my channel cater for that exact purpose. I've shown how from zero to hero, how a person can start investing in the US market from Malaysia and also many other countries. For Malaysian in specific, because I'm a Malaysian, so I can provide more perspective and more solutions and more tutorials, right? I've shown people, I compared 14 different brokers in one video before, 30 minutes video, just to compare 14 brokers. I've done funding tutorials, how to create bank accounts, how to transfer your money, what are the options to transfer money, so that you don't buy into my words. See for yourself what's the right, how much you are paying, everything transparently. Then I also show you how to use brokerage platforms. You can learn how to buy and sell, how to use a platform. I also teach you the basics of investing, show you the portfolio allocation guide, understanding yourself, understanding money, investment strategy, highlighting the best practices. That's basically everything you need when it comes to investing, not just in US market, any other market as well, right? Obviously, investing in Bursa is much more easier. You go to Maybank, you go to M Plus online, you go to Rakuten, open an account within 1 or 2 weeks. Well, obviously with Rakuten it's easier because it's nominee, right? Nominee CDS, right? Within like few days you can start trading Bursa stocks. With Maybank, maybe because a lot of it's direct CDS and there's a lot of paperwork, right? 2 weeks, 3 weeks, you can start buying Bursa Malaysia stocks. Yeah, so the process to invest in the US market is not as daunting as people think. It's basically like signing up for an online subscription, but you need to provide the relevant documentation, your tax info, which is very easy. It's not as hard as people think. Just fill in everything. They will ask you to fund your account, and the hard part, which is it will take a little bit of time to set up, is probably the funding portion, because like the same thing goes to funding and opening account. You can obviously fund using your Malaysian account to their international accounts. That will take a lot of money because you are using local banks, foreign telegraphic transfer. They charge like what, $20-25 per transfer, agent bank fee, right? So to say, just to convert your ringgit to US dollar, $25. And then within that, they take a huge chunk of forex spread. So if today ringgit, US dollar to Malaysian ringgit is what, 4.4 ringgit per US dollar, right? They'll probably convert for you at 4.2. That's a huge spread that they're taking. Wow. So in total, you are losing a lot of money per conversion towards the US dollar, and coming back, you're losing another spread. So I've done the maths before. You probably lose around 5 to 8 to 10% per transaction using foreign telegraphic transfer. So I personally, that's where I try to create content to help people not to spend that kind of money. They can do it either through third-party remittance company, which are also licensed by Bank Negara Malaysia. They are in the form of Wise, TransferWise are previously they call it TransferWise. So you can do it through Wise, you can do it through Instagram, you can do it through Sunway Money, Big Pay. You know, you just need to be creative with it. And all those platforms are licensed and regulated in Malaysia. And I'm not just asking you to like randomly use Cyprus Exchange or Cyprus license kind of company, right? They are all Bank Negara Malaysia licensed e-money and also remittance company. So they got the relevant license already. They're regulated by Malaysian regulators. So it's you just need to be creative, basically, and you will save a lot of money rather than just trusting banks to do everything. Yeah.
I see. I mean, like, what are some things that the people should be careful of? Because, like how safe is all these brokerage accounts? Because, like, when people invest in like crypto, like FTX, like their whole money can be gone if FTX collapse. So, how safe is people's money when they invest in all these brokerage accounts? I mean, invest via all these brokerage accounts.
No, I think that's a very fair question, because I myself asked that question as well. So you need to understand that crypto exchanges, they are largely unregulated. That means the owners or the management of the crypto exchanges, they have full reign of your cash. They can do whatever they want. They can commingle, we call it commingle funds between investment and also users fund. So they can use your money and go and bet somewhere else, and when they earn some money, they pay you back. That's why they can pay like 8% yield, 15% yield, 20% yield. They're so-called staking or farming the fancy term, which is, well, in a way, it's just Ponzi scheme . So now the house of cards has fallen. So you have seen crypto exchanges bursting left and right. So they are unregulated and they don't have insurance in place. So that in itself gives you a huge red flag. Whereas for the regulated brokers like IBKR, Interactive Brokers, TD Ameritrade, or Charles Schwab, these kind of big brokers, right? They are regulated. They are licensed in different countries. They are also regulated by the top tiers US regulators. FINRA, which is the financial industry regulator in US. They are also regulated by the Securities Commission in the US, which is like the SEC in Malaysia SC in Malaysia Securities Commission Malaysia. So they are regulated by FINRA, SEC, and they are also, your money with them is also insured by SIPC, which is Securities Investors Protection Corporation. So it's like a Great Eastern kind of insurance, but government controlled kind of Great Eastern, just to insure your money. In case anything happens to Interactive Brokers, the government will pay you based on the insured amount. So the insured amount is up to $500K US. So that's for brokers that are regulated and insured by the US . Obviously, if the broker is housed and regulated in different countries, which for example, Interactive Brokers in themselves, right? They are not just based in, they are headquartered in US, but they are also based in different countries, in the UK, in the Hong Kong, Singapore as well. So they are regulated by their respective countries' Securities Commission. In Singapore, Interactive Brokers, or just a lot of brokers, they are regulated by MAS Singapore, Monetary Authority of Singapore. So ask yourself, do you trust the regulators that controls the US dollar and regulators that controls the Sing dollar, the two strongest currency in the world? If you think you cannot trust them, then obviously, I mean, be my guest, you can go for local banks . But if you can't trust them, then that if they can manage the two largest currency or the two most stable currency in the world, right, then what else they can't manage, right, when it comes to these kind of financial institutions?
I see. Okay, I think fair enough. So I think to make it simple, because there's so many brokerage accounts, I think I would say that the most popular and so probably arguably the safest is probably Interactive Brokers, right? So how much do they take as a cut when you invest through their platform? Let's say if I invest 10,000.
Commission fee?
Yeah.
Yeah. So in general, I think per trade they take about 35 cents commission fee plus a little bit of miscellaneous fees, regulatory fees, and etc. Probably 50 US cents per trade, or up to $1 around that . So 10,000 ringgit, right? Probably you are paying 4 ringgit per trade. That's like 0.04%. That's very small.
Okay.
So
that's very
yeah,
good.
it's very small. Yeah.
Okay. And how long does it take to sign up with that platform and then you can start investing in the US market? Like, how is it in minutes, or do you need to wait like few days?
Different platforms obviously have different timing. For Interactive Brokers, because they're established, even their eKYC, everything is very well established already. So you can probably through signups probably take like 5 to 10 minutes just to fill out all the forms as online as well, and then like verification, SMS, TSA, all this kind of thing. Probably within 30 minutes, you will get 10 30 minutes, you'll probably get confirmation that your account registration is submitted, your application is being reviewed right now. So if there's no issue, usually within few hours, or worst case scenario up to 48 hours, your account, if there's no issue, then it will be approved lah. So once the account is approved, that means you are now the legal owner and legal owner of the account. Then you can start putting money into it, which takes another 24 hours, and then counting already long. So within 1 week, you can already start investing in the US market. It's that simple. It's not as hard as people think, and in fact, it's much faster than local banks one. Like, trust me, I got a Maybank Trade CDS account, right? Direct CDS account, which I've shown people on my videos before, a long time ago lah. Even as a Maybank customer, I got savings account, I got credit card account, credit cards, savings account, and also brokerage account. It took me about 3 weeks just to activate, and a lot of paper just to sign off because of tax declaration, FATCA, FATCA, all these kind of declarations, right? Took me 2 physical trips to the Maybank branch, and also about 3 weeks of waiting time before I can start buying US stocks. That was the most cumbersome thing I've ever done before.
And
until today,
trips
the
to bank
procedure
is like
is still
the
the
worst.
same. Exactly. And even like 6 months ago, 8 months ago, I went and applied for a Maybank Shopee credit card. I still need to go and sign like 3 sets of declarations. I just don't know why.
Yeah, and then you need to wait for your turn and all those kind of things.
Yeah.
So,
Exactly.
yeah, so
That's
yeah,
ridiculous,
thank God we have this kind of brokerage accounts that make our life simpler and so cheaper as well to buy. So yeah, I think, okay, to wrap up, what is your 2023 investment outlook?
Oh, 2023, I mean, to be fair, it will be choppy. It won't be a serve, and inflation is slowing down in the US. We are seeing 7.7%, probably lower in the coming December CPI. Probably lower inflation, probably some rate cuts in 2023. But I don't think it will be as smooth sailing as the past 2 years, because the damage has been done by pandemic, and the Federal Reserve, the central bank of the US, have already reduced interest rate by 4-5% in 1 year alone. So now they are trying to reverse the cost. It's going to damage people because you have made people rich in 1 year's time. Any shitcoins, any stocks, literally stocks left and right, property left and right, all shoot to the moon already. Now you are trying to reverse that. People are going to get poor. Things are going to break in the economy. Either in the jobs market, unemployment rate is going to shoot up, or either in the stock market, it's going to crash 30-40%. I don't know. That's a possibility of it happening because we have shot up so much, almost like 70, 80, 90% in 2 years' time, which is very unprecedented. So to reverse that course, a lot of pain will be involved. Whether it will be a soft landing like the US central banks are saying, we don't know. That's very optimistic. Optimistically, soft landing. Pessimistically, it will be a hard crash. And I think people, before even think about the investing, right, make sure that your bottoms are covered. Make sure that your personal finances are well managed. If you have a strong cash flow, good, then you can invest, start taking a little bit of risk and not just sitting and waiting. Because to be honest, timing the market is probably the last thing you want to do when it comes to investing. You're wasting that. It will go lower, but what if it doesn't? Do you start FOMO and jumping into the market? No, right? So better to just stay true to the real and just dollar cost average slowly.
Yeah. So every month just put like the specific amount of money and then
Yep. Personally, I like to do that.
Can
like
the
at least
brokerage
10%.
account do that for you, or do you have to like manually add the amount every month?
Good question. So for local brokerages, you can do that. For international brokerages, unfortunately, you can't do that unless you are from countries that they support those currency accounts. For example, if you are from the US or you are from the UK, you can auto debit from your UK GBP account, or you can auto debit from your they call it ACH lah, automatic clearing house. Like in the US, you can auto debit your money out from the US bank account. But unfortunately, as a Malaysian, with just Malaysian ringgit account, you can't do that. So that you don't have that feature. But with local brokerages like probably Rakuten Trade, you can do that. Not just Rakuten Trade, like FSM1, MIDF Invest. Local brokerages, you can do that. But to be honest, how much time does it take to fund your account? 15 minutes. Do you don't have 15 minutes to manage your funding and look at your account? Then doesn't really make sense. But yeah, to answer your question, we don't have that convenience when it comes to auto debiting for other accounts, for international accounts.
Okay, got it. So yeah, I think that's all. I mean, I've learned a lot from this episode, and yeah, I think the only logical step is to check out the US market and also interactive brokers next lah. So yeah, thanks Ziet for coming onto the show. Check out Ziet's channel down below, and I'll see you in the next episode.
Oh, thank you, Benjamin.